This is GPS, the Global Public Square. Welcome to our viewers in the United States and around the world. I'm Fareed Zakaria. I believe that we are all watching a major policy experiment unfold, perhaps the most important in decades. As you see, the governments of the world's largest economies seem to be set to begin withdrawing the money that they had started spending last year to rescue their economies. This is happening in the United States, China, Europe, and it is turning into a test of two profoundly different views of economics. The first, that is apparently being adopted by the G20 countries, says we have to start paying down our debts because otherwise the cost of borrowing money will get prohibitively high. Today it's Greece, tomorrow it's us. On the other side are those who are saying this is crazy. Cutting government spending will put the economy in a tailspin. It will lower growth, lower confidence, and it will produce persistent and rising unemployment. So should the government worry more about unemployment today or the bond markets tomorrow? The two most important intellectuals in this debate are Paul Krugman, the Nobel Prize-winning economist, New York Times columnist, Princeton professor, on the one hand, and Neil Ferguson, the Harvard historian, business school professor, and author on the other. Today, we are going to be talking to both to give you the best case on each side. And I'm actually going to push off my own take on this subject until I've listened to both of them, and then you'll hear from me as well. We've also got some startling news for you about Al-Qaeda and a very sweet story about July 4th. But first, Krugman versus Ferguson. The stakes are only the future of your prosperity. You won't want to miss it. And now I welcome the Nobel Prize-winning economist, Princeton University professor, and New York Times columnist, Paul Krugman. Paul, good to have you.
Good to be on again.
You wrote in a column last week that you thought the world was in danger. In fact, it was likely to enter a third depression. Explain what you meant.
A depression, we don't have a formal definition, but a depression is an extended period when the economy does badly, when there are periods of recovery but they're weak, then they're followed by further slumps, unemployment stays high, there's a constant pressure towards deflation. Worldwide, we've only had two of those. One, the depression everybody knows about, which was very extreme, but then a more moderate but still ugly period of probably a decade or more after the Panic of 1873. We've just experienced only the third really global financial crisis, again, 1873, 1929, and now this one, and we're responding to it in ways that almost guarantee, unless we do a U-turn on policy, guarantee that this is going to be another period like that.
You saw what the G20 agreed to, the 20 richest countries in the world, as a major step backwards and a very dangerous step.
That's right. Now, like all international meetings, it wasn't very binding. It wasn't clear exactly what follows, but what mattered was the mood. The mood was all, we've basically dropped any discussion about doing further things to bring down unemployment, and instead it's all about budget austerity, and we got to bring those deficits down without any context, and at a time when this is really should not be our first priority.
Why do you worry so much about unemployment, other than the human cost? You talk about how persistent unemployment, if people stay out of the job market for a long time, it sort of feeds on itself, and they then never get employed.
That's right. There's a couple of things. One is that effect, hysteresis in the jargon. But basically, if a worker's been out of the workforce for 3-4 years, it's going to be very hard for that person to get back in. The job references will be bad. The experience will be lost. We've seen that happen in European countries that had high unemployment, and by the time they finally started to get it down again, some of that unemployment had basically become structural, had gotten built in. So that's one thing that's very severe. If we do this, if we don't deal with this now, we may find that 7-8% unemployment is the new normal. The other thing is that each year that we go on like this, we're drifting closer to deflation.
Explain what that means and why is that dangerous.
So deflation is when prices are falling instead of rising. And we're actually, you know, most of the way there. We came into this crisis with underlying inflation around 2.5%, which was good. You want a little bit of inflation, gives you more flexibility. That's now down under 1%, quite easily could be negative by the end of next year. That's bad because when your problem is that people are not spending enough, that there isn't enough borrowing, there isn't enough investment, there isn't enough demand in the economy, deflation, deflation makes holding on to cash, just sitting on idle cash, look like an attractive thing to do. And
because prices will drop 6 months from now, and you're always waiting for prices to keep dropping.
In Japan, which has now been in deflation for about 15 years, I was told some time ago by a Japanese economist that the only consumer durable that was selling well was safes, right? People hanging on to lots of cash, and basically we're already part of the way there. A lot of companies are sitting on cash because, hey, it doesn't really erode in value given that we have almost no inflation, and if it becomes deflation, it's going to be even worse.
So your solution to this, though, this is the part that I think a lot of people have trouble with the United States running a budget deficit of 10% of GDP, with debt-to-GDP ratios moving up into the 60, 70% range, you're saying what we need is significantly more government spending.
Right. And sure, I mean, we do have a long-run budget problem. So, you know, starting point is to acknowledge that there is a problem, that if you ask about the state of the U.S. public finances 15 years from now, under current policy, it looks pretty grim. So something will have to be done. The question is, what about now? And if we skimp on supporting the economy now, first of all, we deepen these problems. We make higher unemployment. We reduce the long-run prospects. Secondly, we do amazingly little to improve our long-run budget position. Give you a number. Suppose we talk about $1 trillion, more or less, of spending in the next year or two. $1 trillion, the U.S. government can currently borrow, if it issues inflation-indexed bonds, it can currently borrow at an interest rate of about 1.7%. So $1 trillion of spending is going to add to future interest costs only $17 billion a year, with a $2.5 trillion federal revenue base. It's not going to make a significant difference, but it could make all the difference in the world to the state of the economy in the near term. So the arithmetic says that yes, well, the arithmetic is basically St. Augustine arithmetic. It says, oh, Lord, make me chaste and continent, but not yet. Yes, let's have serious fiscal adjustment, but not until the economy has recovered.
But a lot of people look at the stimulus, $800 billion, and they say, we did everything Paul Krugman wanted, and it didn't work.
As it happens, I have a track record here, because at the beginning, when the stimulus was being discussed, I looked at what we knew even then about the severity of the financial crisis and said, this is not enough. And so it has proved. I mean, you say $800 billion, and it sounds like a huge number. You say that even on the administration's own forecast, at its peak, it would only produce unemployment that was around 1.5 percentage points lower than it would otherwise have been in a world in which it was fairly predictable we were going to see a large rise in unemployment. This is what you expected to see, maybe a bit worse, but this is not, you know, if Obama and Congress had given a stimulus of the scale that people like myself said was necessary, and that had failed, then we could have a discussion. But in fact, they did something inadequate, and the results are disappointing.
But